Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
Today we have three major stories for you. First up, the US government is in talks to take a 10% equity stake in Intel. We'll explore how this move, pushed by Commerce Secretary Howard Lutnick, could turn the CHIPS Act into a direct government investment vehicle. Then we pivot to the senior living crisis. New construction has stalled, creating a goldmine for investors, but it's leaving a growing missing middle unable to afford rents that now top $12,000 a month. And finally, the race to replace Federal Reserve Chair Jerome Powell is officially on. Treasury Secretary Scott Bessent has confirmed 11 candidates are in the running, just as Powell prepares for what could be his final speech at Jackson Hole. The United States government is in discussions to become the largest shareholder in Intel. Now, this isn't just about money, it's a fundamental change in how the government interacts with private industry. Historically, the US has given grants or loans. This new model is more like a venture capitalist taking a direct ownership stake in a critical company. The story really kicks off with the Trump administration demanding a massive equity stake in the chip maker in exchange for billions in CHIPS Act funding. We're talking about a potential 10% stake, a number that sent Intel's stock soaring nearly 7%. At its core, this move turns the entire purpose of the CHIPS Act on its head. The act was designed to boost domestic semiconductor production with over $50 billion in subsidies. This changes it from a simple subsidy into a direct investment, with the government wanting a return for the American taxpayer. And this isn't a negotiation for new money. This is a dramatic reversal of a deal committed under the previous administration. This is critical because it signals a potential new era of industrial policy where the government doesn't just hand out money to support strategic goals, it buys its way into the boardroom. Commerce Secretary Howard Lutnick put it bluntly on the record, stating, "We should get an equity stake for our money." He contrasted the new policy directly, saying, "The Biden administration literally was giving Intel for free. Donald Trump turns that into saying, hey, we want equity for the money. If we're going to give you the money, we want a piece of the action." This is a game changer because it transforms a broad industrial subsidy into a targeted tool. It gives the administration potential leverage, not just over a company's finances, but over its strategy and leadership. To put that 10% figure in perspective, the Japanese conglomerate SoftBank just invested $2 billion to acquire a 2% stake in Intel. The government's proposed share would dwarf that. However, if you zoom out, you'll see another layer of strategy at play here. This isn't just about Intel. Lutnick suggested this could be the new playbook for other major chips recipients, like Taiwan Semiconductor Manufacturing Company. This is where the global ripple effect comes in. If the US demands equity from its own champion Intel, what precedent does that set for a foreign company like TSMC? Their home government in Taiwan is already expressing concerns, and you have to wonder if this could trigger a wave of what some are calling equity nationalism in the global tech supply chain. The administration says the government would have no voting or governance rights, describing the move as simply converting a grant into non-voting equity for the American people. What's not immediately obvious is the creation of what some are calling the silent partner paradox. Even without voting rights, the government can exert enormous soft power. Think about it. Informal discussions, regulatory pressure, signaling future policy, a shareholder as powerful as the US. Government doesn't need a vote to influence a company's decisions on everything from research and development to geopolitics. But this power play comes as Intel is navigating its own internal turmoil. The company has been struggling to capitalize on the AI boom, recently slowed construction on its flagship Ohio factory complex, and just installed a new CEO after ousting his predecessor. So for Intel, this amounts to a potential Faustian bargain. The company has faced major financial losses and is desperate to catch up to rivals like TSMC and Nvidia. This infusion of cash could be a lifeline, but it comes at the cost of tying its future directly to the political winds in Washington. This all begs the question, is the federal government about to take a controlling financial interest in one of America's most iconic and vulnerable tech giants? From a government-led shake-up in the tech world, we now turn to a crisis-driven gold rush in a completely different sector, senior living. Let's start with a single statistic that paints a stark picture. The US senior living market needs 100,000 new beds every year through 2040. The number actually being built this year and next, just 4,000. The impact here is profound. This isn't just a temporary slowdown. The capital crunch stifles innovation in how these facilities are designed and prevents the adoption of more sustainable, modern building practices. Essentially, the very projects that could redefine senior living for the better are the ones being put on hold indefinitely. This isn't a small gap, it's a chasm, and it's creating a massive shake-up in the real estate world. The reason is simple. More than 4 million baby boomers will turn 80 in the next 5 years, creating what one CEO calls the longevity economy. But as demand explodes, new construction has hit a wall. Annual inventory growth just fell below 1% for the first time since 2006. One developer, Aegis Living CEO Dwayne Clark, describes the situation with a stark warning. He says, "There's a problem brewing, and the only metaphor I can think of, it's like putting a party balloon on the end of a fire hose and watching it increase with great velocity until it pops. The culprit? High interest rates, which he calls a catastrophic problem for new development. This is where the situation takes a more complex turn. This catastrophe for builders is a goldmine for investors. Venters, a real estate trust with a $31 billion market cap, is buying billions in senior living assets. Now, this model creates an inherent tension when a real estate investment trust, or REIT, owns the building, but a separate company operates it. The REIT's goal is to maximize profit, often through lease structures that demand fixed rent increases every year. This puts immense pressure on the operator to cut costs, which can mean reducing staff or services, potentially impacting the quality of care for residents. It creates a fundamental conflict between the financial goals of the investor and the well-being of the people living there. Their CEO, Deb Cafaro, says she's seeing returns in the low to mid-teens, and that in her long career, she has never seen that combination of investment characteristics. Another firm, Harrison Street, saw its net operating income from senior housing jump more than 30% last year, calling this the strongest entry point for investment in its 20-year history. They're benefiting from the exact problem plaguing developers. With no new supply, existing properties are becoming more valuable and rents are soaring, with some communities now averaging $12,000 a month. So what exactly does $12,000 a month get you? Well, to justify these high costs and manage staff shortages, high-end facilities are increasingly integrating age tech. We're talking about AI-powered monitoring that can reduce emergency response times, telehealth platforms for remote doctor visits, and even social robotics to provide companionship. Some studies show these systems can decrease medication errors by 25% and are a huge draw for those who can afford them. This brings us to the heart of the problem. That $12,000 a month facility is completely out of reach for the vast majority of people. This crisis is creating what experts call the missing middle seniors who earn too much to qualify for government aid like Medicaid, but not nearly enough to afford private care. And this is the crux of the issue. Researchers at the Milken Institute project that by 2029, over 14 million middle-income seniors will fall into this exact gap with no affordable options available. So while investors are capitalizing on what they see as the opportunity of a lifetime, the core conflict deepens. With millions of people about to need a place to live, where are they all going to go? For this massive and growing missing middle, there is currently no answer. That is the real crisis hiding behind the investment boom. Disclaimer, all market data is subject to change. This report is for informational purposes only and does not constitute investment advice. We were just talking about how high interest rates have stalled senior living construction. Well, speaking of interest rates, the public battle to control them and the entire US economy is heating up in Washington. The race to control the Federal Reserve is officially on. Forget a quiet succession plan. We're talking about a blockbuster showdown with 11 candidates now in the running to replace current chair Jerome Powell. Treasury Secretary Scott Bessent just confirmed the White House is fast-tracking the process with interviews starting right after Labor Day. He's calling it an incredible group of contenders. And the list reads like a who's who of American finance. It includes current Fed governors like Michelle Bowman and Christopher Waller, but also Wall Street heavyweights like Rick Rieder of BlackRock and David Zervos of Jefferies, alongside former central bank officials. Having Wall Street strategists in the running is a potential game changer, and the stakes couldn't be higher. A fascinating aspect here is that their experience isn't just in traditional macroeconomics. It's rooted in high-frequency trading and financial technology, or fintech. A Fed chair with this background could seriously shake things up. We could see a much faster push toward a US central bank digital currency, or CBDC, to compete with other nations like China. This could modernize our entire financial system, but it also raises huge questions about privacy, cybersecurity, and the role of traditional banks. A so-called fintech chair would be a massive pivot from the past. But that's not the whole picture. The real turning point is a fundamental shift in policy. Powell's term doesn't even end until May 2026, so why the sudden rush? The White House is pushing for an urgent need for interest rate cuts. Treasury Secretary Bessent made it crystal clear, stating that a big cut here could facilitate a boom or a pickup in home building. And this decision has huge implications for the tech sector. After all, interest rates are like the gravity of the financial world, and a big cut would have a massive effect. Lower rates make borrowing cheaper, which means venture capital flows more freely to startups. It's fuel for innovation. On the flip side, a Fed chair committed to fighting inflation with higher rates would make capital more expensive, forcing startups to focus on immediate profitability instead of long-term growth. So the winner of this race could either ignite the next tech boom or put the brakes on Silicon Valley. He even dismissed a recent inflation report showing the largest monthly price jump in 3 years, signaling the administration's focus is locked on stimulating the economy. This sets the stage for a dramatic final act for the current Fed chair. This Friday, Jerome Powell is set to give what will likely be his final keynote address at the Jackson Hole Symposium. With the shadow of his potential successors looming and the White House openly calling for rate cuts, all eyes are on him. And I mean all eyes, both human and machine. Behind the scenes, an entire technological arms race in Fed watching is underway, with traders and hedge funds deploying sophisticated algorithms to analyze every single word Powell says, even his pauses. This has completely changed how the Fed has to communicate, forcing them to be incredibly precise to avoid sending the wrong signal to the machines, because even the slightest change in tone can trigger billions of dollars in trades in a fraction of a second. Will he defend his policies, or will he signal a change is coming in September? The battle for the future of the American economy is no longer happening behind closed doors. It's happening right now, in public, and the outcome will affect every single wallet in the country.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.